Couldn't be more excited about today's guest on the Palomar Perspective, Ryan Cockerill with Agree Realty. Ryan started his career as an agent with Marcus and Millichap prior to transitioning to the principal side with Agree in 2016.
Right.
Ryan is the Executive VP of Acquisitions with Agree. Agree is a publicly traded company specializing in investment-grade single-tenant assets. I think as of the end of March, you all owned about 868 properties in 46 states, totaling 16.3 million GLA. Ryan, thanks for being a guest on the Palomar Perspective.
Honored to be here, Ryan. I think maybe McCardle's like the Joe Rogan, but you might be like the Howard Stern of retail real estate.
Is that the hair? Is that the hair or the?
It might be the hair today. It might have been the hair today.
Okay, I appreciate that. While establishments are open here, I obviously have not gone to see my my hairstylist at Great Clips yet. Planning on getting that done here shortly. It's been a big week for Agree. You guys had an earnings call on Monday, and after a bit of a drag in the real estate space, I think your stock's up something like 10%, just about 10% since Monday.
It's a good week to talk to me, I guess. No, yeah. So we did hit the market with the year-to-date release, kind of a snapshot of Q2. We're fortunate. Our tenancy is top-notch quality. We've collected 87% rents both in April and now May, and I think we have some clarity of kind of how that's going to go from here on out. On the acquisition front, we've been as active as ever. We still did $227 million in Q1. We didn't kill any deals related to the COVID pandemic. We're having a strong Q2 as we gave a little hint Monday in our Monday release. We closed 13 Walmart Supercenters year to date. We're focusing on the best players in the space, the TJXs, the O'Reillys, the AutoZones, Tractor Supply. We're doing some dollar stores, and we're busier than ever right now.
It's awesome, yeah. Well, we'll get to plenty of the business points. We kick this thing off typically with a part of it we call the common area, where our large audience, I think we're up to about 15, 18 followers on Twitter, and get to know Ryan a little bit.
If you give me your tag, I'll get my mom. That'll maybe
for sure. I mean, ours is entirely friends and family. We're like, how do we get non-friends and family to follow us?
I have like 3 or 4 friends.
Dealing with the shutdown. I know Michigan's been a little more conservative on opening back up. How's the family doing as y'all dealt with this shelter in place?
Yeah, we're figuring it out. So I'm in the office. I've been back here for about 10 days, but it's a skeleton crew. So the official shutdown was June 12th. We were extended to June 12th after last month, but they rescinded that. So the email just went out today that we're bringing everybody back next Monday. So we're a little behind everybody else, maybe besides New England and the tri-state area. We're excited to get back to it. The family's doing well. My wife's on maternity leave. So this is her last week before she goes back to work. So can you see the bags under my eyes?
Yeah, well, it's been a good time. It's been a good time to have you at the house, I imagine.
Yeah. Day and night. Yeah, but no,
so
everybody.
That's great. Glad everybody's well. Congrats on the new baby, by the way. It's awesome. Nothing better than being a father. University of Michigan grad. Okay, can you explain industrial and operations engineering?
Yeah, the tag is IOE, in and out easy, right?
Okay.
So it's
yeah.
No,
well,
so I wasn't mechanical engineering, not aerospace, not biomedical. IOE.
Sure.
No, but yeah, it's manufacturing based engineering. Six Sigma, lean manufacturing, all that good stuff. I don't know what the hell I did getting into real estate back in 2009. My mentor in real estate is pretty funny. He hired me in 2009, right in the midst of the Great Recession. He asked me, like in 2012, he's like, when did you get involved in real estate again? And I said, 2009. He goes, what the hell were you thinking, right? So just like all of us, yeah, I don't know. We picked it. It's been a great little run. I was at Marks and Millichap for 7 years, focused on net lease. That's how I met Agree. And then I've been at Agree for probably 4.5 years now.
Yeah, it's a great story. I think '09 coming into the industry does speak a lot to you in that big challenge, right? I mean, the market was in turmoil, upside down.
Right. Didn't know any better.
Going into the brokerage world, which is highly dependent on relationships and a lot of times long-standing relationships. So, how was that transition when you went from Marcus and Millichap and on the dark side with brokers like us, where you're just fighting and scratching and clawing to survive,
Shark Tank,
to being
right,
on the principal side with Joey and the team, particularly at a really exciting time, in that you went over there in what, 16, as y'all were just really continuing to ramp up, and you weren't nearly where you guys are today. What was that transition like?
Right, my arrival was really the pivotal moment. And the reality is I came over at a great time. The people at Agree is really why I came over here. I love brokerage. It was a good time. I was looking for something a little more. Had the opportunity at Agree, and it was really the people that got me over there, over here. And it continues to be an exciting ride. The principal side's a little different, right? It's still, as you said, all about relationships, right? Now it's more than just maybe a seller relationship on the brokerage side, but also our clients, not only are brokers but also tenants, and we're really focused on building kind of the best relationships we can with the best operators in the space right now. So it's exciting. I would say it's a little more depth of understanding that I needed to learn over here, but it's been a great ride.
Yeah, that's a good point. One of the questions, I'll go ahead and just jump into it. Your entire team, y'all are about as active as any group we deal with as it relates to just sourcing deals, proactively, constantly being in contact with guys. And I imagine it's because of that broker's background on having to be out in the marketplace, looking to source. When you look at the deals you guys acquire, again, touching on that, y'all do create a lot of wholesale opportunities. What percentage would you say of the deals y'all take down are deals that are on the market, deals that are coming up through those relationships and your team sourcing them, or deals that are just direct with tenants you have relationships that are looking to do sell leasebacks like the Sherwin-Williams deal y'all did a few years ago?
Yeah, good point. I guess I'll start with the first part of your question is how we're sourcing deals, and it's brokers are our lifeblood, right? Whether they're off market or on market, our track record speaks for itself, but a history of successful closings with the brokers we do business with, goes a long way. We rely on those relationships to really get the inventory in and put up the numbers that we do. Now, as far as sale leasebacks, we're not actually that active in the sale leaseback space like a lot of our peers. We've done a handful of transactions. You mentioned the Sherwin-Williams transaction, which was very visible. That was the largest sale leaseback transaction we've completed in our company's history. Since then, we've selectively done some sale leaseback deals with NTB. A couple of those, we did one earlier this year. But again, it's not really our business. I think there will be some more activity in the sale leaseback space, just given the circumstances that a lot of retailers are in right now. We will selectively look at those, but not a huge part of the business.
Sure. You touched on it a little bit early on. Everybody wants to discuss receivables, collections. You guys have made a big pivot in the last few years to a heavy focus on investment grade tenants. And it appears that you all have greatly benefited. No one could really forecast a pandemic hitting the commercial real estate market, but the reason you go investment grade is they're able to withstand downturns in the marketplace, et cetera. Can you speak a little bit to what that has looked like for you guys over the last 2 months on collections, and then within that, your investment grade tenants versus the rest of the portfolio?
Yeah, it's kind of funny when everything's good. Nobody cares about where the rent's coming from. It's just coming in and you're paying a dividend. And I don't think we were necessarily awarded for the quality of the portfolio. And unfortunately, it's very visible now. We receive rent from every investment grade tenant that we own. We collected 87% rents in April, and then again in May. Again, I think we're out of the worst of it for our portfolio right now. And historically, yes, over the last 24 months, we have leaned into more investment grade credit retailers, specifically in what we call e-commerce recession-resistant sectors, with a focus on retailers that are also investing in an omni-channel platform as well. Continuing to go down that line, it's been Walmart's. We closed 13 Walmart Supercenters year to date, as I mentioned to you. Dollar General's, Credit C-Store, Credit Grocery. We continue to just try and identify the best players in the respective sectors we're looking at and solely focusing on those tests.
Yep. A lot of our conversations with guys are, we're waiting around for the opportunities, right? Where's the distress? You see in distress, and everyone's like, man,
Sure.
Anybody's guess. I wish I knew. I wish I had a crystal ball. But that being said, we are getting some runway behind us. Have you seen any price softening, any opportunities? If you have, where have you seen those? Has it been really the opportunity maybe in the security and the assurity of closing with a group like you, as opposed to really a distressed seller? So opportunities softening in value. What are you seeing?
Yeah, I mean, I think it's a supply and demand thing. If you look at the stats going from single-digit transaction velocity and volume, up from 2019 in January and February, and then it essentially fell off a cliff with a 40% reduction and 75% reduction in April. There's just not the demand out there. The deals aren't getting done. I think there is going to be a softening in demand, which typically dictates a shift in pricing. Have we seen it yet? If you asked me a month ago, I would say definitely no. We're not really seeing distress motivated sellers. I think the last couple of weeks, what we're seeing is people kind of evaluating certainty of execution, and also just having cash in hand. I think a lot of people are actually planning for more opportunities down the road if they're hanging on to an essential retailer, or they can still get pretty good pricing right now. They're willing to, maybe not get top dollar pricing, get that deal done, get the cash in hand because they see more opportunity down the road. So selectively, yes, we're seeing it. We were wondering if we were going to see that on the multi-tenant front, whether those multi-tenant owners would need cash. I think it's been a lot of, kind of chaos and asset management on that front. And I throw it back at you to see if, you're going to send me that big outlet portfolio, or if we're going to start seeing some multi-tenant owners carve out, the non-essential anchors, maybe the TJXs, the Hobby Lobbies, things like that. We're ready for that, just given what we've done on the equity side, but we haven't quite seen it.
Yeah, I agree. I mean, that's a good question and transition. We are seeing, for us, even in the deals that we have in the marketplace, we're seeing discounting come, not necessarily because of the distressed seller, but because of, like you said, surety of closing, qualified buyer, not as dependent on the debt markets. I do think owners are continuing to look at how do I create value. A lot of owners, particularly ones we deal with, maybe private, regional, are looking for cash and capital. Some of them are looking for that because they do anticipate opportunities coming up. So they're spinning off, bifurcating out parcel, 2-tenant building, really because, we feel like there's still some value there. They're not giving up a lot of value in the marketplace, particularly for the deals that are straight down the middle. And they're essentially, filling that coffer up to go and reposition that capital and the opportunities that may be ahead. With the guidance you guys are giving the marketplace, what are the kind of acquisition goals for the remainder of the year? Then within that, who are the target tenants that you guys are getting the most excited about, and the team saying, hey, Ryan, here's what we need, go get it?
Yeah, great question. And publicly, after Q1, we did increase guidance from $600 to $700 million to $700 to $800 million. I would say that was a separating factor from our peer group and other publicly traded companies out there. As we talked about earlier, the quality of our portfolio has allowed us to, I guess, weather the storm better. Everybody's gotten hit, but it's on a relative basis right now. We're fortunate where we can, raise the equity. We raised $1 billion in the last 6 months. We need to deploy that going forward. And again, we're going to continue to focus on the best operators in the space, the Credit C-Store, the Credit Grocery, the Walmart Walmarts of the world, the TJX, the Hobby Lobby, the Ross, the Burlingtons in the junior box space. We're not going to focus on, the lower credit profiles. On the net lease side, going down the spectrum, right? We do a lot of AutoZone, O'Reilly's, Bridgestone, Firestone, NTB, all the retailers that are doing well right now. We're going to continue to, kind of do what we've always done, and that'll really be the remainder of the rest of the year what we're going to focus on.
Awesome. All right, you got through all the tough questions. I know Joey is probably getting a little nervous that you're going to start taking his spots on CNBC. I'm glad you could deal and get a little trial run with some of the best in the game. We wrap this up with a piece we call underwriting. It's where, kind of off the cuff, non-real estate questions where guys can get to know you a little bit better.
Great.
As mentioned, you are a University of Michigan grad. You're a football fan, correct?
Harbaugh, the way he's crazy, he can't win the big games, but you got to love the guy, right?
But we'll let you, subtly kind of express your feelings towards him. What I'm going to do here is I'm going to name a few coaches and players and ask you if they were a retailer, who they would be.
Wow, okay.
Okay?
Right.
Bo Schembechler.
He's like the Walmart, man. He's the best there ever was in terms of Michigan. Right?
That's what I had. That's what I had down.
There you go.
Me and you, right here. All right. Rich Rodriguez.
Good history, couldn't get it done, moved on, not really relevant now. I don't know. Man.
You want a lifeline on this one?
How much do I want to dog him, I guess is what it comes down to.
Do you want a lifeline?
Give me a lifeline, Rhymes. What did you have?
Crystal Burger.
Okay.
Kind of niche-y. Is it going to sustain the test of time? They've good times, and now they've hit, rougher times. Gimmicky a little bit, right?
The Coles. Right.
Okay. Jim Harbaugh,
man, he's a firecracker, right? Who's making all the noise right now? Is he like the TSC of the last 60 days? I don't know. Doing well, 20%, same store sales growth. No, everybody knew him before 60 days. I don't know.
Okay, good. Charles Woodson.
Man, the classic. Maybe he's like the 7-Eleven. Always tried and true. Still name recognition. Gonna always be around. Know that name forever.
Yeah, 24/7 reliable. Right. Final one. Tom Brady.
Man.
You already used Walmart.
I know, the best of all time, right?
Maybe one that, was underappreciated a number of years ago, now is really well thought of.
Is he the Chick-fil-A,
Ooh.
with the competition in the chicken sandwich space? I don't know. I think he's still got it. Can he get it done down south? Time will tell, but maybe he'll have a strong finish.
We'll see. I mean, Chick-fil-A's had mixed reviews as they've gone outside of their backyard, but we'll see. A lot of fun, Ryan. Thanks for participating on the Palomar Perspective. Guys, if you'd like to have a conversation about investment sales, investing in commercial real estate in general, feel free to reach out to a Palomar team member. We'd love to have a conversation with you. Ryan, thanks a lot. Look forward to catching up soon. Hopefully we'll see you on the Freedom Tour.
Ryan, I look forward to the Freedom Tour. Make it up in Detroit. Great work that you guys have been doing. You guys know what you're doing. We always like to use you guys as a resource down in your neck of the woods, and I wish you the best and continued great success. Thanks for having me.
All right, buddy. Thank you so much. See you.
Thanks.